get going right now. So as service continues, we will have the speech begin. So I'm really honored to have the opportunity to introduce the Deputy Governor today. First, just to note that this is a unique event for the Ottawa Economics Association. We've partnered with CFA Ottawa, and this is the first time, as far as I know, that we've ever had this sort of partnership before. And we're really happy to do that, and it's just great to see so many people out for this. And I hope this leads to some new networks and connections as a result. I also just wanted to note on, given that we're talking about the Bank of Canada today, we have an upcoming event on June 11th. It's a presentation on the financial systems review. The FSR report comes out on June 7th and is always a very highly anticipated report. So if you'd like to learn more about it, come out and join us on June 11th, and we'll have a special briefing at the Bank of Canada. With that, though, I will now introduce our distinguished speaker, Deputy Governor Lawrence Schembri. Lawrence Schembri became Deputy Governor of the Bank of Canada in 2013. In this role, he oversees the bank's analysis of domestic economic developments and shares responsibility for setting monetary policy in Canada. Mr. Schembri first came to the bank in 1997 as a visiting research advisor on sabbatical from his post as Associate Professor of Economics at Carleton University. He joined the bank permanently in 2001 and became Chief of the International Economic Analysis Department 4 years later. In 2010, Mr. Schembri was named advisor to the governor, a position he held until his current appointment. Mr. Schembri holds a Bachelor of Commerce degree from the University of Toronto, a Master's in Economics from the London School of Economics and Political Science, and a PhD in Economics from the Massachusetts Institute of Technology. His published research has focused on exchange rates and monetary policy in open economies, the international monetary system, and financial stability. So with that, please join me in welcoming Deputy Governor Schembri to the podium.
Thanks, Brian, for the kind introduction, and good afternoon, everyone. I appreciate the invitation to speak to you today. Now, an important, if sometimes underappreciated purpose of central bank speeches is to help the public understand what we are trying to achieve and why. And a greater understanding of monetary policy actions helps make them more effective in practice. And as a public institution, we have an obligation to highlight and demystify the concepts that guide our thinking in a way that all interested citizens, not just the experts in this room, can grasp. Rares sont les membres du public qui, par exemple, se préoccupent de la production potentielle, le sujet de mon discours aujourd'hui. Yet this somewhat abstract notion of potential output is vital to how most central banks evaluate inflationary pressures and conduct monetary policy. At the Bank of Canada, being able to estimate and project potential output has contributed notably to a strong record of meeting our inflation objectives. At the same time, the dynamics of potential output are primarily shaped by slow-moving forces that can take time to have a material impact. It can take time to have material impact. These include demographic shifts, capital accumulation, and technological change. Equally important, many of these same forces influence a country's standard of living. A significant development in recent decades is that the growth in potential output has been on a generally downward trend in major advanced economies, including Canada, largely owing to population aging. This trend has important implications for our macroeconomic policy frameworks and our economic prospects. My remarks today are organized around four separate but related questions. First, what is potential output? Second, how do we measure it? Third, why is it important for policy? And finally, what policies have supported potential output growth in the past and could again in the future? The answers to these questions should help you to better understand not only our policy in the near term, but also our thinking about policy making over a longer horizon. Let's turn now to the first question. We usually refer to potential in the context of individual achievement as in realizing one's potential. When I was much younger, for example, my aspirations for my own potential included growing as tall as my favorite player on the Dallas Cowboys, becoming a pitcher for the Toronto Blue Jays, and obtaining a PhD. My immigrant parents placed more value on education than on sports, so they were quite relieved that I only managed to achieve 2 out of 3. For central banks, potential output represents an assessment of what the entire economy, rather than a single person, is capable of achieving on a sustainable basis. It is a measure of aggregate or total supply in an economy. We consider both the growth rate of potential output as well as its level. An economy's capacity is normally always growing as its available resources and their productivity expand. Now let's dig a little deeper. Most central banks, including the Banque du Canada, interpret an economy's actual output growth, its GDP, as being determined in the short run by forces moving aggregate demand. An economy's potential output growth, meanwhile, reflects the evolution of aggregate supply over a longer horizon. Aggregate demand growth tends to move with short-term factors such as shocks to foreign demand and exports, which may trigger cyclical movements in, for example, inventories and consumer purchases of durable goods. Aggregate supply growth is affected more by the slow-moving forces that I noted earlier. Consequently, actual output growth is generally more variable than potential output, as shown in this chart, where you see the potential output is the dotted line and the actual is the blue. So you can see that because potential output is determined by slow-moving forces, they're much less variable. So a challenge in pinning down potential output growth is disentangling the short-term fluctuations in GDP caused by demand shocks from long-term fluctuations that are due to the underlying forces that drive aggregate supply. Since the forces that determine aggregate supply tend to change slowly, we focus on trends when thinking about and measuring potential. Now, it's rarely as simple as just separating short-term phenomena from long-term. The Great Recession was a once-in-a-lifetime shock to aggregate demand that, because of its severity, also affected aggregate supply via its negative effects on business investment and the labor market. Consequently, a decade later, this experience continues to have an impact on potential output in advanced economies. So the disentanglement challenge is twofold. First, identifying the trend movements as opposed to the temporary or cyclical ones. Second, identifying the forces driving the trend movements, which also helps us predict how long they'll persist into the future. I'll go into more detail shortly about how we measure potential output growth, but for the moment, let's look at a useful decomposition. One way to consider potential output growth is to break it into 2 components. First, the long-run growth rate of total hours worked in the economy, known as trend labor input, or TLI, and second, the long-run growth rate of how much output is produced per hour of work, known as trend labor productivity, TLP. This chart illustrates the TLI-TLP decomposition by showing each of the components' respective contributions to Canadian potential output growth since 1992. The chart reflects the findings of the bank's annual reassessment of potential output growth, which we recently published as an appendix to our April monetary policy report. 2 observations in this chart are important. First, the chart shows a secular or persistent decline in TLI, thus in potential output growth. Population aging is the biggest reason, and it is only partially offset by immigration. Second, TLP's contribution to output growth has also declined somewhat from the period before the global financial crisis. TLP growth is expected to increase modestly in the coming years. This is mainly because the slowdown in investment and productivity growth that followed the sharp decline in commodity prices a few years ago turned out to be less pronounced than we initially expected, and the economy's adjustment from it is now mostly behind us. This is good news because TLP growth is expected to play a larger role in potential output growth over the projection. There is, however, considerable debate about how much we can expect productivity to rise in the future, even as the emerging digital economy promises to transform how firms operate and how they use their workforces. Let's compare Canada's experience to that of other countries. This chart shows that Canada's experience has been similar to that of other advanced economies. Potential output growth in Japan, the US, and key countries in the euro area is also much lower than it was in the 1980s, largely due to the same forces causing the slowdown in Canada. For Canada specifically, annual potential output growth from 2009 to 2021 is estimated to average about 1.8%, much lower than the 2.7% average from 1982 to 2008. With all of this in mind, let's tackle the hard question of how to measure potential output. Measurement of potential output is a challenge because it is hypothetical, or what it could be. Therefore, it's not directly observable. Estimates, as a result, carry considerable uncertainty. At the bank, we have developed and used a variety of estimation techniques to help manage the uncertainty. These are living techniques that are continually being improved. Now let's consider these different techniques. Techniques for estimating potential growth can be viewed as being along a spectrum as shown in this chart. At one end are simple statistical models. These aim to capture underlying trends in output growth by mechanically filtering out short-term fluctuations. The problem with these techniques is that they are essentially a black box. The data going in and the estimates coming out are known, but there's little economic explanation of how they are connected. At the other end of the spectrum are structural models that rely primarily on relationships between variables based on economic theory to identify and quantify the impacts of different sources of potential output growth. For example, higher levels of investment will cause the capital stock to rise faster, leading to more rapid TLP and potential output growth. However, structural models may produce inaccurate estimates if the economic theory on which they are based is incorrect or incomplete. The bank uses a variety of models along this spectrum that combine statistical filters and theory-based structural approaches. This is done so that we can cross-check the estimates of each model and then combine them to get a reasonably robust estimate of potential output growth. And you can see the different measures, the different techniques we have along the spectrum. So let's consider the results from these different models. This chart displays estimates for potential output growth from 4 separate models along the spectrum I just had on the screen that are part of the bank staff's toolbox for estimating potential output growth. Now, models that incorporate economic structure are especially useful for projecting TLP growth, since TLP is based on variables and relationships that are difficult to measure and predict. TLI is comparatively easier to forecast, and the reason for that is because it's based on accurately observed labor market outcomes, the employment rate, the working age population, and average hours worked. In contrast, TLP growth depends on 2 variables that are less concrete and therefore more challenging to observe precisely. The first of these, capital deepening, is a measure of growth in the ratio of capital per hour worked. The second is a more elusive concept called trend total factor productivity, or TFP. While we have some observable measures of investment and capital stock growth, we do not have the same for trend TFP, which essentially includes everything affecting firms' productivity that is not captured by capital stock growth. These residual factors include, for example, technological improvements and the impact of education and training. I would like to stress that the bank recognizes the difficulties associated with measuring potential and the related uncertainty, and so takes a deliberate and rigorous approach to managing this uncertainty. We work hard to ensure that our models evolve in line with prevailing best practices. And on top of using multiple techniques, we corroborate the model's results against other measures of capacity and inflation, and then apply well-informed judgment. Finally, the uncertainty around these estimates is taken into account in the formulation of monetary policy. This helps ensure that our estimates and our policy decisions are consistent with our broader economic outlook. Now let me expand on why potential output is important for the conduct of monetary policy. A key concept is the output gap, the difference between potential and actual output. It is an important determinant and useful indicator of inflationary pressure. For example, a negative gap implies the presence of economic slack, and inflation would be normally below target, assuming inflation expectations are well anchored at our 2% target. Our monetary policy framework embodies the expectations augmented Phillips curve that captures this relationship. This expectations augmented Phillips curve, it's a nice coincidence. Milton Friedman published his AEA presidential address exactly almost 50 years from today in 1968 that explained this concept that most central banks have as a basis for their policy making. Because monetary policy operates with a well-known lag, it must be forward-looking and depends on the current and projected evolution of the output gap. The bank sets the path of interest rates to affect aggregate demand, close any output gap, and return inflation sustainably to the 2% target. Let's examine further the relationship between the output gap and inflation. Now this chart shows the bank's three measures of core inflation or underlying inflation. They all increased steadily over the past year. That followed with a short lag the narrowing of our measure of the output gap. This evidence demonstrates how we use other data to corroborate our estimates of the output gap, which helps ensure a coherent economic outlook for monetary policy. Although the inflation targeting framework has been very successful in the past, it faces important challenges in the future. Slower potential output growth is contributing to a lower neutral policy rate. Global equilibrium real interest rates have been declining due to a number of factors. Lower business investment, in particular lower potential output growth implies that the expected return from investment is less, and so that's reducing business investment than it would be otherwise. And also higher savings are taking place globally because people are living longer. These types of factors are reducing global equilibrium interest rates and contributing to a lower neutral policy rates. As a consequence of this, there's less room for central banks to reduce the policy rate in response to an adverse shock before hitting what we like to call the effective lower bound. At the effective lower bound, several central banks have used unconventional policies such as large asset purchases, and the evidence to date indicates that they've been generally less effective than the traditional policy rate changes, and they may also increase financial vulnerabilities. Lower potential output growth, therefore, represents a challenge for both monetary and fiscal policy frameworks. Lower potential output growth implies lower fiscal revenue and likely less fiscal space for countercyclical policy, especially as age-related expenditures increase. Given lower neutral policy rates, central banks in advanced economies are revisiting their policy frameworks to enhance macroeconomic resilience. Le prochain renouvellement de la cible de l'inflation avec le gouvernement du Canada, prévu pour 2021, est une occasion de revoir notre cadre de politique monétaire. Durant ce processus, nous examinerons des moyens de relever ce défi et de renforcer notre cadre afin de croître la résilience de l'économie canadienne. Let's consider the last question about policies to raise potential growth. To maintain solid potential growth and rising living standards in the future, what policy lessons can be drawn from the past? Over its history, Canada has experienced strong growth and rising living standards. Great economic opportunity has stimulated employment and investment in capital, while encouraging investment in individuals through accessible quality education and an inclusive social safety net. We've also benefited from robust political, legal, and economic institutions and from openness to trade, investment, and immigration. Despite those advantages, developing the appropriate policies to maintain solid potential output growth in the face of an aging population is a formidable challenge. That said, I'd like to touch on 3 policy areas that have been successful at promoting potential output growth in the past. First, education. I've benefited from the opportunity created by my own access and my parents' commitment to good quality education at all levels. Second, immigration, which is something I know a bit about since my parents arrived from Europe to Canada in the 1950s. And third, trade liberalization, which I've studied and analyzed for most of my entire professional life. For education, the objective should be to improve quality and access and equip students with the skills needed for a technology-based economy. This will require harnessing public and private investment and leveraging new educational technologies. Such an approach will help to reduce rising income inequality, which has been caused in a large part by technological change that benefits those with more skills. In terms of immigration, higher levels of immigration are helping to offset the impact of an aging population. But we need to match skills of immigrants with elevated vacancies present in our economy at the moment, and also promote the integration of immigrants into our workforce. For trade liberalization, there have been a number of recent agreements. The agreement with the European Union, the agreement with countries in the Pacific Basin, and the interprovincial agreement to liberalize trade amongst provinces. These build on past success because they reduce cross-border and internal barriers and create opportunities for Canadian firms, and thereby encourage investment and productivity growth. Now is the time for me to conclude with 3 key messages. First, potential output is an indispensable input into the formulation of monetary policy because the output gap is important in determining inflationary pressures in the economy. Using the output gap as our guide has helped underpin the success of the Bank of Canada's inflation targeting regime. That regime has delivered on average inflation at the 2% target on a consistent basis for more than a quarter century. Second, the bank's multifaceted approach to measuring and using potential output, drawing on diverse tools and different sources of information, helps to manage uncertainty and to ensure reasonably robust estimates. This deliberate and regularly updated approach has also contributed to our success. Third, like other advanced economies, Canada faces important challenges to our policy frameworks and to our economic progress from lower rates of potential output growth. Nonetheless, we have a rich history of generating economic opportunity and supporting growth. We should draw from past lessons in developing future policies. In closing, I mentioned earlier that although potential is mostly a function of longer-term, slower-moving forces, the Great Recession had a severe and protracted impact on potential output. With our economy now operating close to potential, solid demand growth is spawning business investment, firm entry, and improved labor market conditions, all of which are helping to repair that damage. Comme il est noté dans les récentes annonces de politique, nous suivons de près cette expansion des capacités économiques. Ce suivi nous aiderait à atteindre notre but, soit le maintien de l'inflation à un niveau bas, stable et prévisible. Voilà ce que la politique monétaire peut faire de mieux pour soutenir une croissance durable et la hausse du niveau de vie au Canada. As I said in French, we are closely monitoring this expansion in economic capacity. It will help guide us in achieving our goal of low, stable, and predictable inflation, which is the best contribution monetary policy can make to support sustainable growth and rising living standards in Canada. Thank you very much for your attention. I would be pleased to answer any questions you may have. Thank you.
Thank you, Deputy Governor, for that fascinating speech. The Deputy Governor has offered to take questions, and we have about 15 minutes allocated to that. So think of your questions, and we'll make sure to get a mic to you. I'm going to take advantage of holding the mic first and ask you a question related to trade liberalization. Do you think that as Canada, with the TPP, once it's in force, will have access to 60% of the global economy, and I think around 90% of our exports will receive preferential treatment? So is there diminishing returns now? Have we reached that point where we have liberalized trade with enough markets that new trade agreements have a smaller impact on potential output?
Well, we've seen a fair amount of trade liberalization in the post-World War II period, and you're right. So a lot of liberalization has taken place, but I think tariff levels are still reasonably high for some products, particularly agriculture commodities. There are barriers to services. So I think there's still room for more trade liberalization with a wider set of countries. What we've seen at the global level is the WTO process, the multilateral process, has gotten bogged down, and so as a consequence, much of the trade liberalization is taking place at a regional or bilateral basis. And we all know as economists that the largest gains are had by having a multilateral approach. And so I still think that at the global level, having broader trade liberalization, including a broader set of countries, would be most beneficial.
It's a little bit outside of the bank's purview because your job is monetary policy. But when we look at education and we look at immigration, both of those can be varied substantially. Recently I was in Finland and I got a briefing on their lifetime approach to education. So we don't waste so much of the life and the resources of young people putting in time in university. They can get into the labor force young, they discover that they like or they don't like what they're doing. The state then enables them to go back with pay to upgrade to the area they want and the economy wants, which would be, it seems to me, a discussion. I know the bank can't initiate this, but a discussion for those of us who are economists to begin to pay more attention to, so that the capital being invested in young people is actually going to yield socially and economically a bigger return and less debt. With respect to immigration, I know that the family reunification element has been reduced somewhat so that the age profile of the immigration structure is a little more different than it is from Canada as a whole, but it's not different enough to replace what really does change population growth, which is having more babies. And it may be immigrants per family have more babies, and that may be a positive result. But these are elements, I know they're outside the bank's purview, but it seems to me there needs to be a much more lively discussion of these in the country to help inform what the bank is doing.
Well, I agree entirely with your comments that I think both education policy and immigration policy are critical. I mean, they are outside our mandate, but they're important to our outlook for potential output growth. And because potential output growth is so important the conduct of monetary policy, we have an interest in that, in those issues. Now, we don't drill down on specific policies because you're right, it's outside our mandate, but I think that Canada can learn from the experiences of other countries in terms of education policy. I think that there's been a wide variety of different experiments tried in different jurisdictions, and I think there's opportunities for us to learn from those experiments. As you know, the example of Finland, I think, is an interesting one, worth looking at closely. On immigration policy, I can't speak directly about the policy vis-a-vis family unification. I know that's always been a priority in Canada to have some of the immigration allocated to that group. But for the most part, you know, my experience, my parents came here as young adults and they went immediately into the workforce. So I think it's important to strike that balance between having those that can enter the workforce relatively quickly, that have the skills to match the vacancies that we have in Canada in our job market, and as well as have the family unification, because it does have social benefits as well. So I think that balance has to be struck, and that's the government's responsibility.
Very good speech, Larry. Thank you very much. I have two questions. One is, I noticed that you have reduced income inequality as a way to promote potential growth, and I wondered if you had any specific ideas in that area. And the second question was linked to this trend labor productivity variable. Isn't there a lot of endogeneity or cyclicality in that? Because it's dependent on investment, and investment is very cyclical, and therefore it's really not a pure trend variable.
On the first issue, in terms of, the first issue was, inequality. Well, the issue, I mean, the main goal really is to equip students with the skills necessary for a technology-based industry. I mean, the rising inequality, the data seems to indicate that it's really driven by those that have the skills to take advantage of the technological change. So it's been, you know, skills-biased technological change that's really driven a large part of the inequality. And so having more students get involved, get exposed and educated in those subjects, I think would help address the inequality. So it's an issue of getting more students with those skills as opposed to just reducing the inequality. Reducing the rising inequality would be an important byproduct. With respect to total factor productivity, you're exactly right. I mean, it is a cyclical, it's a function of investment. This is one of the tensions we face in trying to estimate potential output growth, because it is affected by the pattern of investment. So it's as I said, it's not easy to completely separate the long run from the short run, you know, the short run fluctuations in investment from the long-term trends. And so investment is clearly one of those issues. So we try to use judgment where we can, but it's a difficult, as you indicated.
Some economists, notably William White, your former colleague at the Banque du Canada, have held that the stimulative monetary policies adopted by central banks over the last 10 years stimulate the economy in the short run, but at the expense of reducing medium-term trend growth through various factors, misallocation of resources, over-indebtedness, et cetera. Does the bank allow for, when it's looking at potential growth over the medium term, does it look at the impact of its own policies?
Well, that's a very good question. I mean, the issue is in terms of the impact of our policies. I mean, lower interest rates, the goal is to stimulate both borrowing by households and borrowing by firms. And one could argue, well, we're seeing more of the investment taking place. The borrowing is going into residential investment rather than business investment, so that's potentially less productive. I mean, we build in the pattern of business investment and our projection for business investment into potential output growth. At the same time, one has to keep in mind that our objective is achieving our inflation target on a sustainable basis. And so when we reduce interest rates, we're expecting both households and firms to borrow, and we don't we don't have the power to allocate the credit. We just simply set the interest rate and allow people to borrow. And so more of it may have gone into investment, but that's the way the market works. And so it is a consideration for us, but I think our overall goal is to really achieve the inflation target, and we recognize that lower interest rates do create financial vulnerabilities, but we feel that the changes to the mortgage finance rules that have been put in place over the last several years have actually been complementary to our monetary policy, in the sense that the credit that that's being generated is actually going to households with the ability to service that debt. So in some sense, it's complementary to what we're doing in terms of monetary policy. But essentially, at the end of the day, that's how monetary policy works. It encourages firms and households to borrow from the future in order to invest today, to support aggregate demand, to reduce the size of the output gap, and move inflation to target.
Hi there. Hi, you mentioned business investment and the importance of that in your projections for potential outcome. Just wondering how uncertainty around NAFTA has, if it has, and how much it has affected the bank's projections for business investment going forward.
It's the uncertainty in NAFTA. That's something that we have a business outlook survey where we survey 100 firms every quarter, and one of the issues that has come up is firms have told us that that's affecting their investment decisions. Essentially, they're holding off some of their investment decisions, making them in Canada. They're looking at investment possibilities in the United States. And so that's definitely, that uncertainty is weighing down on investment. And it's also having an impact on exports, because what we're seeing in the economy now is we're operating close to potential. And so many firms don't have the capacity to expand further without investment and increase in exports. And so we're seeing this combination of limited capacity and limited export growth. And the capacity is being hindered by firms being reluctant to take on investment in an uncertain environment. And some of that uncertainty is definitely related to NAFTA. So that's an issue. And that's part of the reason why we believe that the economy is operating close to potential. Inflation is is close to our target of 2%, yet monetary policy is below the neutral rate, in part because we have to lean against the drag coming from the uncertainty created by NAFTA.
Hi, can you comment on productivity growth? In particular, you had a slide where I think the bank forecasted higher productivity growth over the next coming years. What sort of drives that?
Our outlook for productivity growth is largely driven by the outlook for investment. So we saw productivity growth decline over the past few years, in part because investment was very weak after the commodity price decline. We now see the economy adjusting almost completely to the commodity price decline. We're in a different equilibrium right now, and so we see investment picking up, in part because, as I mentioned, many firms are at capacity. They see their demand growing, and so we expect them to expand capacity to meet demand. And some of that demand is domestic, and some of that demand is coming from abroad. But we feel that given the conditions are strong and the outlook is strong for solid demand growth, that they will take on investment going forward. And so that will raise productivity, in part because, as I mentioned, workers will have more capital to work with, so it'll be capital deepening that will be contributing, but also because a lot of the new machinery and equipment will embody new technology, and so we'll get an increase in total factor productivity. So those two forces will be helping to raise labor productivity going forward.
Hi, Larry. Thanks again for coming today. This is really great. One of the things that came out of the April NPR was that along with the increased forecast for potential GDP growth, there wasn't a commensurate increase in the outlook for the range of the estimate of the neutral interest rate. So I was wondering if maybe you could speak to that a little bit and why that might be the case. Thanks.
Thanks. Good question. The reason we looked at adjusting, where the neutral rate should be. And because Canada is a small open economy, our neutral rate is largely determined by global forces. And so what happens in our economy, whether we're, if we raise potential output growth slightly, could have an impact on the margin. But for the most part, we felt that we have a broad range for where we think the neutral rate is, between 2.5 and 3.5%. And so on average, it's, midpoint is 3%. But we didn't feel the adjustment in potential output growth that we made in the April reassessment was sufficient to really move the yardstick, so to speak, because in large part, the real interest rate, the equilibrium real interest rate in Canada is really determined by global forces, and those haven't really changed sufficiently to warrant changing the neutral rate. Now, that could change in the future if potential output growth and some of the forces that have been driving down global real interest rates were to reverse. The neutral rate might be revised upwards, but at this juncture, we didn't feel we had enough evidence to really make a meaningful change.
If there are no further questions, I would like to now invite Roxana Lund from CFA Society to come up and thank the Deputy Governor for taking the time and so generously answering so many questions from the crowd. So,
as Brian mentioned, I'm Roxana Lund. I'm the Strategic Initiatives Chair of the CFA Society Ottawa. First and foremost, I would like to thank Deputy Governor Schembri for joining us today and making this presentation. I think the number of questions and the nature of the discussion demonstrates that this was a very thought-provoking and well-received presentation.